Don't place a trade based on what you'll see in this video because there is no guarantees of making a profit in the market. It takes you a long time to become a good trader. So this video here is just to educate you to become a much better trader. Hey traders, John Howell here. And in today's video, we're going to be covering the SP 500, the Nasdaq, the Dow. Also be covering the mining stocks and silver and gold in this video as well too. What's been going on through there. Something really interesting that I'm seeing right now when it comes to the GDX and the GDXJ. So I really want to share that with you as well too. Plus also there's a chart that I want to show you of a certain sector that the defaults of this have been very low for pretty much the most of the last sort of 5 to 8 years, but then it's now starting to rise, and that may be trouble underneath the surface. So I'll talk more about that. And then the last thing I want to talk about is why it's not all bad news what we're seeing here right now, and what I actually expect to see after the next, say, 1 to 2 years, what I expect to see out of the property market and so on and so forth. So let's get straight into it, guys. So what we're going to look at here is I firstly want to share with you what's going on right now with the overall indexes and the overall indices through here, because it's really, really, really interesting to see. Look at this through here, okay? We can actually see that what I did, the video that I did yesterday was based on these trend lines here, okay? So I said, yeah, I was talking about yesterday how we actually had this support line through here. See this support. It had a very nice support line. We broke and we could not break back above it, and then we rolled over. So the question is, are we doing the same thing now? If we hold here and break back up, then that's not going to be the same thing here, right? But if we hold and we continue to roll over here, because we're starting to get a little bit of a rollover, not much, but if we continue, if we do continue to do that, then we're going to create this sort of lower high through here. And especially if we break the 2500 level, then yeah, we're probably going to race down to 23, probably even down to 22 level, somewhere around the 22,000 level from there. So that's one thing I'm really watching to see. What's the market going to do here? I don't think we're going to race up to new highs, and I don't think we're going to get down to new lows this year. I think this year is probably going to be a bit of a sideways range from there. You know, guys, that's what I'm seeing there right now. But the whole thing about trading, guys, for you is that it's important to understand how these markets work and how to trade these charts. Have really, really good trading systems and so on and so forth. So this is what I'm doing right now, guys, for a special. I'm running a $7 special to the complete trading course. You're going to get chart reading strategies. You got 2 powerful trading systems, Ultra Trading System, Blast Off Trading System, #1 trading indicator. You know, you got a whole bunch of things. If you are struggling your trading right now and you need a breakthrough, this is the breakthrough course, and you need to say, okay, I need some help. I just want to get some help. Then this is a really, really, really good starting point. Go to johnsflashsale.com. $7 only, and you can get access to this complete trading course right now. It's a breakthrough trading course to help you with the foundations, chart reading, trading systems, and so much more to help you become a much better trader. So go to johnsflashsale.com. So let's have a look at the S&P 500 here now, guys. And the S&P 500 is doing the exact same thing as well too, right? We have a low, we have all these high lows, all the way up, and then now we have these sort of, see how the market ran up and then we rolled over? Is the market going to do the exact same thing here and then roll over? Is that what's going to happen? Because I don't think we're going to get to new highs. And guys, what I think and what actually happens is almost always wrong. So it's probably going to race up to new highs now. Right? So that's what I'm seeing through there right now. And also, but on the flip side, the same for the Nasdaq, right? The Nasdaq. The same for the Nasdaq. Once again, guys, if we have a look at this here, right, we have all this support levels all through here, and notice how we actually could not break it back above it, and then we finally rolled over, and then when we did, and we got that gap down, as you can see, once we actually broke that low through here, that's when it was all over, wasn't it? So right now, if we hold here, which I think we have a really good chance of actually having a bit of a turning point here, guys, because we've been, yeah. Anyway, so if we do roll over here, if we don't, it's going to completely be a continued blow off, right? This is no longer a V bottom. This is a V bubble. If we do continue up, it's going to continue the V bubble. We just never know how long that's going to be. But if we do roll over through here, right? This is the if scenarios. If we do roll over here and we break this 9,400, Then I see a nice drop back down to 8,200 level, that 8,200 level through there. That's where I see the Nasdaq probably getting down to. If we create this sort of topping pattern through here, all right? So this is a massive topping pattern that I see. And so that's what I'm seeing through there, guys. But we still need this rollover first. I don't know what's going to happen here right now, but if we start to get those rollover, then and we break that low, it's going to be all over red rover for the markets, right? So we're still breaking above that 10,000 level there. I need to take that off the screen now because we're no longer sort of respecting that high level through there. But you can see we're still underneath this major trend line that's coming on through, and that's what we're seeing through that. Now, one of the things that I do want to share with you is I want to share with you this here. Look at this here. This is really, really fascinating. This is the what we're calculating here is the bank card default index. Right, so it's calculating obviously the defaults, and you can see here over the last sort of 1 year we've had sort of, it went from sort of like 4 down to, you know, we had a bit of a dip down through to here, and it started 2019. And notice how in as the start of 2019 to where we are right now, notice how we're starting to get a bit of a rise. What does that mean in the big scheme of things? If I go to 3 years, now we're starting to see something, right? So you can see over the last 3 years, it's been pretty flat. We went up a little bit, down a little bit, up a little bit, down a little bit. And now look what's happened, right? We've actually broke up to an all-time new high. That's a warning sign, right? And then when I go to my 5 years, now you're like, oh my goodness, this is actually starting to slowly trend to the upside. We did go up for a little bit and then it flattened out, and now we're actually spiking up again on the bank card defaults. And if I go to my 10 years, you can actually see here, right? Look at this here. The 10-year, we had a bit of a drop down. We had a bit of a sideways phase, but now we're actually breaking up all-time new highs above these highs through here. So that's actually, that we're starting to see that, and it's been down for a long time. So are we about to see bank card defaults rise even more through here? So really, 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 really interesting stuff. The other chart that I wanted to share with you was I think it was the first mortgages. So the first mortgage default index. Let's go to the 10-year here. That's not what the one that's actually dropping down through here. So obviously we're not getting defaults in mortgages, are we? Because obviously because of you know everything that's we're not getting defaults in mortgages right now because of obviously the forbearance, right? But remember, everything goes in cycles, doesn't it? So when it comes to this here, we've been down through here, and for the last pretty much say 5 years now, we've been down and we're dropping even lower. To me, guys, that actually screams, yes, we're down low a lot through here, but that tells me we're now getting ready to go through what? Another cycle. What is it? A cycle. Everything goes in cycles, right? We just never know when the cycle is going to end and start and complete and all that sort of stuff. And what I mean by that, everything goes in cycles. When the unemployment's really, 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 really low, guess what? We end up getting a spike. And then it pops back down again. And then we get a spike, right? Everything just goes in cycles all the time. So when there's blood in the streets, go buy that. When everything's really, really, really good. So we're getting here right now. I would not be too surprised to see over the next couple of years that something happens and we start to get a bit of a default rise to the markets. Now, that may take another 4 or 5 years and then we start to rise, right? We just never know, but we're probably likely to start to see that. The best time for me to buy property is and I'm really interested in buying property, is I'm looking at the markets that's been devastated for the last 10 years. Why? Because I'm buying in at the bottom of cycles, right? Now, when it comes to my property investing, I don't know exactly when the exact bottom is going to be with my cycles, right? So if I'm seeing something that's been decimated for 10 years and I get in here, right, I'm buying property I'm going to hold probably for 10, 20 years or longer. Even if it drops down a bit, am I worried about it? No. Why? Because I know probably over the next 2, 3, 4 years, we're going to probably see something like that. Why? Because everything goes in cycles, doesn't it? Everything goes in cycles. Like, for example, if you, I'll get into that in a minute. I was going to say, for example, gold, right? Gold had done nothing. What? Gold had been the worst performer for the last 4, 5, 6 years. Now, what has gold been doing? Gold's been what? Going through a boom period, right? Everything just goes in cycles. If you start to understand, and same with life, right? Things go well, things don't go well, and so on and so forth. But it was the second rate, right? It was the second mortgage default. This was actually really interesting. If I bring up the 10-year view here, let me zoom in on this chart so I can show you what I'm looking at here. Let me bring this up a bit more. Right, look at this here. Isn't this interesting? I just realized this. Look at this here, right? We had a bit of a drop down, and then from 2014 through to 2017, not much going, and then suddenly we got a big spike, right? From the start, from July through to from June, around June or August 2017 to the end, right? So this sort of 6-month period is when we started getting rate defaults, the second mortgage defaults on there. Now I wonder if that was because of the interest rates, right? And then suddenly what happened, right? They started dropping interest rates, and then suddenly it went back down to normal again. So it's really interesting to see what you know, this whole spike through here, and what the interest rates are doing. And guys, when it comes to this overall, I'm about to get into silver and gold and the mining stocks. But before I talk about that, guys, I believe that after we go through this bit of a washout period, and what I mean by that is over the next, say, maybe 6 months, 12 months period, how we go through a bit of a washout period after this whole coronavirus thing. Guys, I truly believe we are setting ourselves up over the next, say, 1 or 2 years, depending how long it takes for this thing, the whole, again, like wash through type thing, right? Until the coronavirus is not even on our mind anymore. Until and then things, you know, jobs are starting to come back again, and things are starting to happen again. The really interesting thing is that I honestly believe that with all the currency that's in the markets right now, and with the velocity of money, right? Let me just show you here. Right, so as the velocity has been dropping down and down and down, remember what I said before, right, guys? Everything is in cycles, right? So over the next probably 10 years, guess what? We're going to start to see this thing tick up. Now, it may be over the next 2-3 years that we start to see this thing tick up. But as you can see, right, it's been in a big, massive downfall ever since basically the mid 1990s, and it's been slowly dwindling down for quite some time. When we start to get an increase, right, with all this currency in the system, and when we start to get an increase of the velocity of money, and with all that sort of stuff, guess what that's going to create? That's going to start to create inflation. Why? Because people are now starting to spend more money, right? The velocity of money is picking up, and if velocity of money is picking up along with all the excess currency that's in our system, that's going to start to push up prices even more, right? That's going to cause inflation. When that starts to cause inflation, guess what they're going to have to do? They're going to be forced to raise interest rates. And when they do that, that's when it's like, it is bad from there, right? Really bad from there. And so that's why I see through there, guys. So when it comes to the actual property market, yes, I do see, like here in Australia, even in America, right? I do see a bit of a short-term pullback, right? Over the next 6 months, maybe even through 2021, we see a pullback. But mark my words, guys, we are just through a midterm cycle right now, right? Especially in America. America went through a devastation crash in 2008, right? And they've just started another cycle. They went through their first cycle, and now they're probably going to slow down for the next maybe 2 or 3 years, right? So, but then probably from end of 2021, 2022, somewhere through there, I honestly believe that the US property market is going to go through another massive boom. Interest rates are low. Interest rates are still really low. Massive currency in the systems. The government's still pumping a lot of money into the system. So there's a massive flaw amongst these markets, right? It's not until once the velocity of money really starts to change hands, and that starts to cause inflation, or if asset prices just get way too out of control and they have to start to put the brakes on, so they have to start to raise interest rates again. That's gonna be the thing that really pricks this. And this I believe that's that time, and I don't think that's gonna happen until probably, the midterm cycle. So I would say probably 2024, 25, 26, somewhere around there. that's where I see, like, especially here in Australia, right? If I'm looking at property here in Australia, I see probably 2021, 2022 is we're going to start to pick up another boom. Or we're going to start to be at the start of another boom. And then around 2025, 2026, that's where it's going to be at probably the peak of that boom. And we're going to go through another couple of years slowdown. The Americans have just started their first phases in the property market there. So that's just what I see right now, guys. I believe that that we're going to go through one last boom out of this here, and then when that last boom happens, I believe that's the thing that's going to prick the biggest bubble of all history, and that's when. And that's going to happen over the next 10 years, right? So if I look back over, if I'm here at 2030, and if I look back over time, there's things that I'm pretty confident are going to happen. One, silver and gold are going to go through the biggest bull run we've ever seen in history, probably bigger than Bitcoin. Two, we would have seen another boom coming right after a bit of a deflation. We'd actually see an inflation of asset prices. Both in stock market and also property market. Now, when I say stock market, guys, I truly believe we're likely to probably see a bit of a downturn coming over the next couple of years. All right, I truly believe that. But over that period, I truly believe we're ready to go for another boom. Or I could be completely wrong there, and the Fed's just going to keep this thing going all the time. But then I truly believe probably the midterms, because all this stuff takes a lot longer than we originally want, right, guys, or than we originally think. So what I mean by that is that it's like, yeah, the government's in too much debt. The government's been in too much debt, for like 10, 20 years, right? Especially the last 10 years, right? It's always been the debt bubble, the debt bubble, the debt bubble, the debt bubble. Yeah, but if they can monetize that debt, if they can monetize that debt, then it's not so much of a bad debt. The issue is when they can't monetize their own debt. And then, yeah, guys, so then I see somewhere in the next 10 years, we're going to see another big inflation period of asset prices and also goods and services, or especially the food, right, starting to go up already. And then the inflation is going to start to pick up even more. And then from that period, we're going to start to see interest rates rise again. And that's when we're going to start to see a slowdown in the markets, right? So I truly believe, yes, we're getting a bit of a dip right now because of the whole coronavirus situation and everything's starting to slow down right now, guys. But over the next, say, 12 months to 2 years, probably 2021, guys, and beyond, especially the property market, guys, I definitely see another big bull run coming. It's not all bad news. So, yes, I've always been, on my videos, I've been doom and gloom, and this is really, really bad. But that's on the short term, right? That's over the next, say, 6 to 12 months, maybe even towards the end of 2021, right? As this thing starts to slowly pick up again. But 2022 and beyond, guys, I'm really bullish property market, even in America. And I'm very bullish, property market here in Australia as well too, and probably the stock market's probably going to go along with it as well too. And it's not until then that they for some reason have to be forced to raise the interest rates, either by the free market or by them actually doing it. But they're forced to raise interest rates. That's the thing that's going to prick the next big bubble. And once that happens, guys, then it's all over. Because if I actually just share with you here, let me just share the actual interest rates here, and I'll share this reason why. The next time they try to raise it, that's the thing that's going to prick the biggest bubble in history, and it's all over red rover from there. Let's go to the United States Fed funds rate here, and let me just share this with you here. Okay, let me go to max here, and I want to share this with you here, right? Because I want to share something with you, right? Every time we go through an expansion or every time we go through a bit of a recession, guess what? They print more money, right? But you'll notice that, right? Look at this here. Every time we go through a bull market, and then we go through an expansion, a bit of a drop in, what's the word for it? Every time we go through a recession, right? They have to print more money. But you'll notice that as the boom and bust cycles actually go through, you will start to see. Let's actually go. we'll go red, right? So you'll see, right, over time, over this history through here, that you can see that the Fed's fund rate up here around 20% in 1980. And you can see, right, as time has gone on, every time they go through a recession period, guess what? They only can raise it so much until what? They prick the next bubble, raise interest rates, then the market drops, right? Then obviously interest rates drop. Then we go through a really good period right now and they start to inflate prices. Then they have to start to raise interest rates again. Right, then the market comes up, and then guess what? Then they prick this next bubble by raising it too much, and then they come down, and then they go sideways, and then they raise it here. They get it to a certain point with the next expansion, and then guess what? Boom, right? And then we go through a bit of a bust, which is this is the 2020 bust, right? And then guess what? And then we go through a bit of a period where we go through the next recession. The market, the interest rates drop, the markets drop, everything's deflation, and then we go through another expansion period. And when we go through the next expansion period, the interest rates rise as much as they can. And then guess what? Boom, right? They get to a certain point, prick the bubble, and that's when the credit and everything just starts to roll over. Because everything's been based on massive leverage and credit, this is the way it's been working, right? 2008, guess what? Same thing. And then they had to drop it down to zero, and then they kept it zero for a while. And guess what happened? After 10 years of all this sort of stuff, 2016 they started to raise it. They raised it up to as much as possible, and guess what? They pricked the next bubble. Now it's back down to here again. So you can see that there, right? Every time we go through an expansion, they have to raise it to cool it down, and then drop it. Now I want you to notice one thing as well too, right? Every expansion in history, every expansion that we actually see, you'll notice what? You'll notice that they can't actually raise the interest rates to the previous high point of the last expansion or the last boom. See that there? Why is that? The only reason why they can raise it to there before the next bubble is pricked, guess what? Because now they've got more debt, right? So the more debt they have, the less the interest rates can go up before it starts to prick something. No, and notice the interest rates go lower this time, right? So it actually goes lower than the previous time, but then it makes a lower high compared to the previous time. Why? Because it drops lower to boost the market. Then when the market starts to pick back up, everything's good for a period of time, they raise it and they get it to a certain point where the government can't take it anymore, and home loans can't take it anymore, and personal loans and all this other credit out there can't take it anymore, and they start to default, and guess what? Boom, they crack. Right? They crack and we go through another what? A recession. Then they drop it down, and guess what? They drop it down to even a lower time, a lower level than the previous time. When they raise it up to the maximum point, guess what? They can't raise it. They can't raise it to nowhere near as much as they did last time through here, right? And then boom. Right, they raise it to as much as they can, but because they've been accumulating more debt this time as well too, they raise it as much as they can, then the market drops, right? And then we go through another drop period through here. Notice how we actually went lower this time on this next recession here in the 2000s, right? The tech bubble. And then guess what happened? And then guess what happened? Then we went through a bit of an expansion, 2003 to 2007. But guess what happened, right? We started to raise and raise and raise and raise. We actually almost got to the limit, but we still made what? A lower high. The interest rates could only go to a certain point before it got too much, and then bam. And this time we actually went down to zero. And then now, guess what? And then now the interest rates are rising and rising and rising to a certain point where they can't take it anymore. And then now they go, and now guess what? This was the 2018 sort of period. And then they raised it to a certain point, and then bam, now they're back down to zero. What's left? Another 0.5% and then dead? Do you see what I'm saying through here, guys? So this here is the reason why that the next expansion, along with the next forcing of rates having to be up, is going to be the death knell for a lot of things. It's going to be the death knell there. And that's where digital currency is probably going to come into play, New World Order and all that sort of stuff. Because there's nowhere to go, right? They keep lowering it, then they keep making it lower than the previous time to boost it, and they only can raise it to a certain point before they keep pricking these bubbles here There's not much room left now, guys. And that's what I'm saying. Over the next 10 years, this is going to create devastation in the markets through here, right? And guys, we're doing the same thing for here in Australia as well too, right? So if I show you the one for the Australian market as well, the Australian market, the Australian interest rates here, like this is the Australian interest rates right here, right? Let me go to maximum. Look what happened here, right? 2000, big drop down, sideways. You can see how it's not as the Australian curve is not as much of a swing like the American markets, right? But we had flat from 1992 pretty much to 2000. We had the bit of 2008 crash, and we've been going down and down and down and down ever since. So that's where, guys, like for people that are watching here that are thinking about investing into Australia property or are living here and looking at investing in property, guys, I'm telling you right now, the next 5-6 years, to right now through to 2025, 2026, even maybe 2027, I'd say 2025 to sort of be conservative there. 2022 to 2025 is going to be a massive boom period for a property. And once they start to raise its interest rates again, that's when it's all over. So that's what I'm seeing through there, guys. It's really, really, really interesting to see, especially with this American one. That's the reason why, guys, this here is a massive trend that is saying that something is just not right here, or it's the next time they raise the interest rate, it's going to be all over from there. Moving on now through to the gold mining stocks, guys, just quickly before I finish up here. The gold mining stocks, guys, we're getting a very nice deep pullback through here. Again, guys, on this weekly chart here, we're getting a very nice pullback through here. I don't believe we're going to get much more of a pullback. We might get a little bit more of a pullback, but I actually see this now being a resting period before we start to see a nice move up. Same for the GDXJ as well too, guys. We may get a little bit more pullback, but very nice big move. Gold has been pretty much doing nothing, going sideways, and this is a calm. When the market does this here, guys, this here is a calm here before the storm. What I mean by that is that when the market goes sideways and it doesn't do much, boom, we're about to get a pretty of a storm, and I believe it's going to be to the upside. Also, moving on now through silver, and I think silver is likely to probably follow along in sync with gold, right? We had a nice move up. We've had a bit of a sideways period, not really much going on. And so once we start to really get a break above that 1850 level, then that's what I see through there. So I hope this helped you out today, guys. Before you go, guys, make sure you go to johnsflashsale.com to grab the $7 sale today, and you grab all this sort of stuff to break through just to get you started on the right foot. johnsflashsale.com. Go there right now.